Hey, good morning, boys and girls. It's time to wake up and get excited. Yeah. It's football season again. That means more Mississippi State football, more updates from me on the thing you most truly like to hear about is football. But listen, that's not why I'm doing this video, right? I thought it might be a good way to connect and kind of get a message out to all my clients real quick and kind of address the elephant in the room, I guess, the quote-unquote market. What's it doing? Everybody's a little uneasy. Maybe you are. Maybe you fit in that category. Maybe you don't. But here I'm trying to offer some calm to the storm, if you will. If you are paying attention to the news, which a lot of you do, I'm sure you saw my buddy, Mr. Powell, the Fed, talk about possibly inflation's not been curbed as fast as he would hope. And that means what? Higher interest rates. And of course, that means a lot of uneasiness in quote unquote the stock market. And so there's a lot of people out there, or I should say talking heads, that I've always warned against on the news, talking about the troubles to come. So here I'm trying to offer some perspective to this, and that's the reason for the video. If you remember when we started down this journey together, you and I, with your investments, what did I tell you? I told you it was about long-term investing, right? And so what does long-term mean? Well, it's 5 years, 10 years. It's down the road. For those of you who are closer to retirement, you may think of, wait a minute, Wheeler, what about, I want to retire in a couple of years. I'm nervous. I'm going to have enough money. Listen, short answer to all of your worries is yes, it's going to be okay. It really, truly is. I'm not going to, bore everybody with Economics 101 here on the call, but I'm going to get into a few things that maybe might make you feel a little bit better. I'm going to show you a chart here that might make a little sense. Real quick is what's called the Dow Jones Industrial Average. And then for those of you who don't know, the Dow Jones Industrial Average is the index comprised of 30 companies, bigger companies, to form that average across different asset classes. Now, those same 30 companies that were around in 1897 when this thing was formed, or not all of them are around today. The most recent one to fall off that's probably notable in your memory is General Electric. Quick story there. When I came out of the Army in 2000, I was like most of you. I didn't know anything. I came out of the infantry. I didn't know anything about diversification, asset allocation, let alone 401k, where to pick, where to put my money. And I did what most of you did. I went to a couple of mentors. I said, hey, what's the best mutual fund for me to pick inside my 401k? Now, what do you think the guys at GE told me? They've been there 20, 30 years through the 80s, the Jack Welch days. GE was just pumping out money left and right. Of course, they told me, hey, Wheeler, you should put it all in company stock. You should put it all in GE because we're in so many different things. We're in locomotives, aircraft engines, power stations, lighting, finance. We're our own mutual fund, Wheeler. Right? So there's a couple lessons there. Obviously, I did that for about 6 months, and then I watched General Electric tank under Jeff Immelt, who's no longer there. So the lesson is, be very careful that you understand what true diversification is. But the point here in terms of the Dow Jones Industrial, even those companies, right, are not around that were around back then. And look how volatile, look what a roller coaster ride this is. You start off, it did great. Then the stock market crash. Here's what we're looking at. I think right about there is 1929. Then, we come up to World War II, right around here. And then we started coming back after World War II. If you look here, we've got 9/11 happened, I think right about here. And then now recently we've gone down a little bit. And again, this is just these 30 companies. So why am I showing you this? Well, we're clearly better off today than we were over 100 years ago. Arguably, we're better off today than we were even 12 years ago. So patience and diversification is key, even in something as small as an index of Dow Jones with only looking at 30 companies. And again, would you feel comfortable if all of your eggs were only in 30 companies? Most of you, I think, would probably say no. So with this, let's take a look at the S&P 500 index. Guys, you have the S&P 500 real quick, and again, if you see where it was started down here back in 1959, and look where it is today here in 2022. You can see in the 90s, just kind of crept up until the 90s, and it really ballooned up. Then we had a little thing called 9/11. It went down. Then it went back up. Then we had 2008 financial crisis, housing crisis, went down. And then for the most part, save this little blip here, and I think in 2020 December, it's not nothing but go up. And so think about that. If at any point in time, if you were a long-term investor and you tried to time the market and you pulled your money out, you wouldn't have known when to put it back in. No one really does. So the important thing is to make sure that you're diversified properly, that you understand that diversification and where it's going. And realize even in this roller coaster of a ride, you're still better off in 2022 than you were back in 2000, clearly. So again, that's why we're talking about long-term investing. If you were worried about just 1 year at a time, then yeah, we need to be having a different conversation. I don't need to be your guy. But we're not doing that, right? We're looking at our serious long-term money. We're looking 5-10 years out. And again, for those of you who are looking into the bond markets, we're going to talk about that here in a minute. So I'm here. Why am I here? I'm here to be the antidote to all this uneasiness and all the uncertainty in this bear market. I wanted to reach out to you personally today and remind you that, hey, we're facing what could be months of market uncertainty as all these investors grapple with fear and worry. So I wanted to let you know about some of the opportunities that might be hiding in all this chaos so that you can avoid some of the mistakes that others make, those average investors. So here's what we're talking about. A quick summary is bear markets are frequently, like I told you, a time of missed opportunities and avoidable kind of mistakes. And here are the three I really want you to keep in mind. So opportunity number one is it's a time for hunting opportunities amid all that chaos. A market downturn means that overall prices have dropped, including those of companies who may have been undervalued at the current price, right? Things are probably on sale right now. Average investors, those day traders, often give in to all the panic, and they can hurt their prospects by buying during a bull market, right? And selling during the bear, rather. Everybody loves when it's winning. You're putting in more money and you're buying high instead of buying low. So opportunity number two is using the buying opportunity when the prices are now depressed. Now's a great time to invest if you are sitting on money on the side. And I know that's very, very tough to do. But again, you want to buy when it's low. So many investors do the opposite, right? They're sitting on the sidelines, they're scared, and that's usually a mistake. And it's impossible, like I said, to perfectly time the market. And so you might miss the ride back up, and that can really hurt your long-term portfolio. And so I encourage you not to sit on the sidelines and definitely not to cash out. Opportunity number three is learning not to be overconfident. We've had years of a roaring market. Everybody looked like a genius. And I think Warren Buffett kind of said it best. What did he say? He said, only when the tide goes out do you discover who's been swimming naked, right? So now's the opportunity to remember that all bull markets come to an end sooner or later. All prices eventually normalize, and no one can predict the future. And that's why we here, me at Exponify, invest the way we do. We make sure that you're properly allocated and diversified. That's why you pay me as a professional to look after your financial life so that you can share your worries and then have someone to help you take that action. So if you have a question what I've discussed, or again, if you'd like to speak more personally about what's going on, I'm trying to get around to all of you here in a timely manner, but please don't wait for me to call you. Feel free to call me. Pick up the phone. You have my cell phone number. Text me, call me, and we'll happily talk about your portfolio, what's going on. Another thing I think that might help you amidst all of this frustration or scared, understand where you're invested. Don't just look at the return. That'll drive you nuts if you're just looking at what the returns are. If you don't know what's underneath those returns, it's going to drive you bonkers, right? What would help some of that anxiety? Understand what mutual funds that you're in. What are those mutual funds designed to do? What indexes are they following? I guarantee you they're not all following the S&P 500, right? We have some small cap funds, which means smaller companies. We have some international companies. We have some mid-sized companies. We have some blue chip companies. We have some dividend paying companies. We have some that are based on hopefully their stock price is going to go back up. Also, bonds are going to start coming back in the mix now that the Feds are raising the rates, and bonds, not today, but sooner or later, are going to start acting like bonds again. And then for those of you, my brothers and sisters who are very close to retirement and very nervous, we're going to slowly start taking out that volatility as these bond prices start to normalize, or bonds start to normalize and act like bonds again. But that's what we're doing. We're waiting to hopefully see that bonds start to normalize out. We're not timing the market. Bonds are like a slow-moving ship. Once you see an iceberg way away, you can start turning the ship and you'll miss it. So that's what we're doing. Let me put it to you. Here's a good example of what I'm talking about. Why am I wearing my Saints shirt here in Dallas, right? I'll tell you why, right? Think about the New Orleans Saints. If I'd have told you back in the 80s that the Saints were going to win the Super Bowl, you just said I was out of my mind, right? I did say it in the 90s, right? I was a little out there, a little ahead of my time in the 90s, right? But what happened? Well, Drew Brees got hurt in San Diego, hurt his shoulder. They let him go. He's a great quarterback. I think we all know that now. But back then, it was suspected he was a good quarterback, but he hurt his shoulder, damaged goods. So what did the Saints do? They bought Drew Brees when his price was low. They didn't buy him when he was high. They didn't do what Tampa Bay did. Arguably, that worked too. It's probably a bad analogy, is Tampa Bay buying Tom Brady and winning the Super Bowl. But let's forget about that for a minute. Let's go back to the Saints, right? So they bought Drew Brees at a very low price. He couldn't get on the team anywhere else. Saints picked him up. What did they do? They won the Super Bowl 6 years later, and they've always been a contender since. Now I'm a little worried going forward. It probably won't be the same. But my point to this is the Saints bought Drew Brees when he was low, and it paid off for them. So maybe that'll help you a little bit, right? Be patient and don't be emotional about investing, right? That's where I come in. And again, if you have questions about your portfolio, what you're in, why you're in it, I highly encourage you to pick up the phone and call me, and let's have that discussion. I want you to know what you're doing. And so I'll leave you with this. I'll say, think about it in terms of this. Are you better off today? I'm going to go Ronald Reagan on you for some of you old school people. Are you better off today than you were before you met me? Okay, now for those of you who just met me in February or January, you're going to be like, no, I'm not better off. My prices are down. Okay, I'm not just talking about in terms of returns. Do you know more than you did? Do you understand where we're going and why we're going there? Do you understand how we're going to get there? That's what I'm talking about. Do you feel more confident in knowing where you're invested, why you're investing, and what it's doing for you? And if you are having trouble answering those questions, then yeah, there's an issue. Pick up the phone and call me. Tell me that you don't really understand, and let's go back over it, okay? And let's revisit your retirement plan, all right? So hopefully this helps calm you down a little bit. It's going to be bumpy waters ahead, boys. It's going to be bumpy waters ahead, boys and girls. So strap in, but I promise you, we'll come out on the other side, and we'll all be okay. I hope this helps. Again, call me if you need me. Thank you guys for your business. It means a lot to me and my family. That trust I do not take lightly. Anything I can do to help, I will happily do so. Just give me a shout. You guys take care.